Gold isn't rallying right now. Gold is repricing, and the part of the market that can T-lie is already telling you the next move is being negotiated under pressure. The headline crowd is going to argue this is just another fear spike, another trade war whisper, another hot money chase that burns out. And that's exactly the trap. Because the real story isn't the spot print you see on your phone. The real story is the structure underneath it. The spreads, the delivery economics, the positioning, the calendar, and the quiet institutional behavior that turns loud when liquidity thins. Stay with me, because by the end, you'll have a clean what to watch next checklist for the next 1 to 2 weeks, levels that matter. Tells that confirm it, and the exact type of move that would invalidate the whole setup. And there's one hidden detail most people miss that changes how you should interpret every dip from here. And that's where the real pressure starts. Right now, in late January 2026, gold has been trading in the mid 4,000s, with recent pricing around the high 4,700s after a sharp push higher, while silver has been printing in the mid 90s per ounce after an explosive start to the year. Those numbers matter, not because they're cute milestones, but because they force behavior. They force hedges, they force margin calls, they force procurement decisions, they force do we wait or do we lock it in, conversations inside companies and funds that done a T-post screenshots. And when the market is forcing behavior, that's when you stop treating it like a story and start treating it like a mechanism. Because this move isn't emotion, it's math. Here's to you, and it's the conflict you are going to feel in real time. One side of the market wants you to believe this is overextended and fragile, that you're late, that silver is too high, that gold is too high, that it has to cool off, because that's what it's done before. The other side isn't arguing with words. The other side is bidding. The other side is paying the spread. The other side is quietly accepting worse prices now because they care more about access and certainty than they care about looking smart on a pullback. And when that happens, the market is telling you it's not a normal trade anymore, but that's not the part that matters. The part that matters is the hidden detail. In these moments, the spread becomes the signal, and the signal becomes the engine. Most people watch spot. Pros watch the curve, because the curve is where stress shows up first. Think of the future's curve like a heartbeat. When everything is calm, the market is happy to push demand into the future. Sure, take delivery later. We'll price it with time, storage, financing, and convenience. That's contango. The future costs a bit more than today. Normal, boring, textbook. But when the front end tightens, when nearby contracts get pulled up, when the difference between metal now and a metal later compresses or flips, suddenly the market is saying something very specific. The convenience of having metal now is rising, and somebody's willing to pay for it. That's backwardation pressure, or at least a curve that's trying to bend that direction. And you do not get that from vibes. You get that from constraints. You get that from financing frictions. You get that from inventory categories that sound like accounting until you realize they are the difference between exists and deliverable. And if that one level breaks, the math changes. Let's keep it clean and non-cartoonish. This is not about secret villains pressing a button. Markets don't need villains to misbehave. They just need incentives. Futures and derivatives let institutions take exposure efficiently. That paper market is useful, and it's massive. It's how miners hedge, how jewelers hedge, how refineries hedge, how funds speculate, how banks intermediate. But paper exposure is not the same thing as physical availability. And in metals, the bridge between those two worlds is delivery economics. When delivery is cheap and available, paper can float above physical without much tension. When delivery becomes expensive, uncertain, or time-sensitive, the bridge creaks. And the creaking shows up in the spreads, in lease rates, in nearby strength, in higher urgency bids, in odd behavior around delivery windows. That's the underappreciated mechanism. Price can be high. But if the curve and delivery signals are screaming, high is not the right word. Tight is the right word. And tight markets don't resolve gently. They resolve by rationing. And rationing happens through price. Here, as the simplest way to picture it, if you are a buyer who must have metal, because you're refabricating or you're fulfilling contracts or you're managing reserves or you're meeting liabilities, you don't get paid for being patient. You get punished for being late. So you pay up today, you secure supply, you reduce uncertainty. That demand doesn't show up as a tweet. It shows up as, I'll pay this premium, I'll take this spread, I'll roll this hedge, I'll accept a worse basis, and that changes the whole tape. But the next detail is what flips the whole setup. Inventory. Everyone throws around, inventories are high or inventories are low, like it as a single number. It's not. In the real world, metal inventories come in buckets. There's metal that is eligible, meaning it meets specifications and can, in theory, be delivered. And there is metal that is registered, meaning it's actually designated and ready for delivery against futures contracts. Then there's metal that's sitting in the wrong place, the wrong form, the wrong ownership, or under the wrong financing structure. That metal exists, but it's not a fire extinguisher when the kitchen is burning. The market cares about deliverable inventory because deliverable inventory is what prevents the curve from kinking under stress. When deliverable inventory tightens relative to demand to deliver, you see it. You see it in nearby premiums. You see it in a reluctance to offer supply. You see it in the way the market reacts to dips. Dips don't get a gentle fade, they get a hard bid. And that's where the real pressure starts. Now, layer in the street symptom that retail can actually feel: availability and premiums. In a loose market, you can get size quietly and the bid-ask is civilized. In a tight market, suddenly there are delays, the premium structure changes, and the market starts steering people towards smaller sizes, different products, different substitutes. That doesn't need a conspiracy to be real. It's just logistics, fabrication capacity, and risk management. Dealers don't want to promise what they can't source. Fabricators don't want to quote what they can't hedge. And when price is moving fast, nobody wants to be short optionality for free. So the whole ecosystem becomes more cautious. And that caution shows up as friction. Friction is a form of tightening. Tightening is fuel. But that's not the part that matters. The part that matters is silver. Because silver is not a polite market. Silver is a leveraged personality. It's part monetary narrative, part industrial supply chain, and part positioning grenade. It can spend months being ignored, then make up years of movement in weeks. That's why people call it the devil metal. And they're not wrong. Not because it's evil, but because it exposes your psychology. Silver lures you into thinking you understand it, then it punishes you for being casual with position sizing. And that, yes, exactly why silver can follow gold toward a right behind it storyline even when the logic feels stretched. Because silver doesn't need perfect logic to move. It needs pressure, and pressure can come from a few places at once. Industrial demand that doesn't blink, a supply chain that can't expand on command, and positioning that is suddenly offside. And if this one level breaks, the math changes. Let's talk supply without doing a boring history lesson. Silver supply is weird. A lot of silver is produced as a byproduct of other mining: copper, lead, zinc, gold. That means you don't get to just turn on silver supply because silver is high. You need the primary metal economics to cooperate. You need permitting, you need refining capacity, you need time. Recycling helps, but recycling is also price elastic and time delayed. There's a lag between price is higher and supply meaningfully responds. That lag is where squeezes are born. On the gold side, supply is also inelastic in the short run. Mines done ramp quickly. But gold has a massive above-ground stock that can, in theory, move. In theory. In practice, a lot of that gold is not for sale at any price that feels reasonable, because it's held as savings, reserves, cultural wealth, or strategic asset. So yes, gold has more above-ground stock, but that doesn't mean it's liquid supply. And in markets, liquid supply is the only thing that calms price. Everything else is a museum exhibit. The next detail is what flips the whole setup: institutional behavior. Central banks and sovereign entities don't chase candles like retail. They buy for reasons that are painfully boring: reserve diversification, geopolitical hedging, currency credibility, settlement preferences, and long-term risk management. And those reasons don't disappear because price is up. Tightening events don't care if you think the chart looks overbought. Tightening events keep going until something changes in the physical incentive structure or the macro incentive structure. And that's where the real pressure starts. So when you hear gold to $5,000, you need to translate it from clickbait into mechanism. How does gold reach a level like that? It doesn't do it by politely stepping higher every day. It does it by compressing risk premia, by pulling in institutional allocation, by forcing the short base to shrink, and by creating a scarcity premium around immediate access and hedging needs. Sometimes it does it through a currency lens: dollar weakness, or emerging market stress, or reserve diversification. Sometimes it does it through a rates lens: real rates falling, or the market anticipating policy easing, or the market doubting inflation will be contained without collateral damage. Sometimes it does it through a credibility lens: institutions looking less stable than they used to. None of those require apocalypse. They require a regime shift in confidence. And that can happen in slow motion, then show up in fast motion. But that's not the part that matters. The part that matters is what $5,000 implies for silver psychology and ratio math. I'm not here to give you a magical ratio target like it's destiny. Ratios are not laws, but they are magnets for behavior. If gold is in the high 4,000s and silver is in the mid-90s, you're talking about a ratio in the neighborhood of roughly 50 to 1. If gold moves toward $5,000 and the ratio merely stays similar, silver is already flirting with triple digits. And if the ratio compresses even modestly, because silver's industrial component tightens supply, because positioning flips, because volatility forces a squeeze, then silver doesn't just follow. Silver overshoots. That's what it does. And that's where people get hurt, both sides. Bulls get hurt by leverage and impatience. Bears get hurt by arrogance and margin. So the only grown-up way to handle this is to hold two truths at once. Yes, the upside is real, and yes, the path is violent, and that's where the real pressure starts. Now let's build a proof stack, because you should never hang your whole thesis on one argument. First proof layer, price behavior. Gold has been pushing to fresh highs recently, and importantly, it's been doing it with urgency, sharp moves higher rather than lazy drift. Silver has been even more aggressive, ripping into the mid-90s after starting the year around the low 70s, which tells you this isn't just a gentle macro bid, this is a repricing wave. Second proof layer, futures activity. When you see big trading volume spikes in futures around these moves, it suggests the market is actively repositioning, not just passively holding. And when open interest doesn't simply balloon alongside price, it can hint that part of the move is shorts being forced out rather than just new longs piling in. That distinction matters because forced exits don't need fresh narratives to continue. They just need price to stay elevated long enough to keep pressure on the remaining shorts. Third proof layer, calendar. A Fed week and month end create mechanical reasons for volatility and repositioning, which is exactly when metals can gap. Fourth proof layer, macro uncertainty and policy credibility noise. When the market isn't confident about the rate path, inflation persistence and institutional independence narratives, hedging demand increases. Fifth proof layer, supply chain inertia, especially for silver. Byproduct constraints and refining lead times don't bend because your favorite influencer drew a line on a chart. And that's not the part that matters. The part that matters is the other side of the trade. What do banks, dealers, and funds do when volatility rises? They de-risk. They reduce inventory risk. They widen spreads. They demand more margin. They hedge more aggressively. And those actions amplify moves. This is where options reflexivity can quietly join the party. You don't need a full-blown meme gamma squeeze for options flows to matter. If a lot of call exposure exists and price rises, dealers who sold those calls may need to hedge by buying the underlying. That's delta hedging. As price rises, the delta increases, so the hedging demand can increase too, especially when options are near the money and gamma is high. That creates a reflex loop. Price up forces hedging buys. Hedging buys pushes price up, rinse and repeat. In a thin market around a calendar catalyst, that reflexivity doesn't have to be massive to be meaningful. It just has to be one more buyer when the book is empty. And that's where the real pressure starts. Now let's address the counterpoints, because if you don't, the market will do it for you with a 3% down day that makes you question your entire identity. Counterpoint 1, a sudden spike in real yields. If the bond market reprices to higher real returns and the dollar strengthens aggressively, metals can get smacked even in a longer-term bull thesis. Counterpoint 2, a broad risk-on melt that pulls capital away from hedges and into higher beta assets, especially if volatility collapses. Counterpoint 3, forced liquidation events. If some levered pocket of the market breaks, funds can sell what's liquid to raise cash, and metals are liquid. That can cause brutal drawdowns that are not fundamental, just mechanical. Counterpoint 4, policy surprises that change expectations quickly. If the Fed communication shifts hard, if inflation prints surprise, if growth data flips the narrative, you can get a short-term regime change. None of these destroy the structural story automatically, but they can change the near-term path. And that's why you need levels and invalidation. Because if this one level breaks, the math changes. Here's the psychology shield. Because this is where most people lose money, even when they're right. Volatility will be weaponized against you, not by a villain, but by your own nervous system reacting to uncertainty. The market will do three things again and again. It will spike up and make you feel stupid for not buying more. Then it will slam down and make you feel stupid for buying at all. Then it will grind sideways and make you feel stupid for caring. That cycle is how it trains you into bad decisions. The antidote is simple but not easy. Separate signal from noise. Signal is the trend structure and the underlying mechanics. Tightness, curve behavior, institutional bid, macro regime. Noise is the intraday whip, the headline of the hour, the social media panic, the "it's over" declaration after one red candle. If your horizon is weeks to months, you cannot let a single session bully you into abandoning your plan. But you also cannot pretend risk doesn't exist. So you use a two-scenario lens and you size accordingly. And that's where the real pressure starts. Scenario 1 is the controlled pullback and retest. In this scenario, gold cools off from recent highs, tests prior breakout zones, maybe even dips into a lower band that feels uncomfortable, and then buyers show up hard. The curve stays relatively tight. Dips get bought faster than they should. Silver in this scenario can drop more sharply, because it always can, but it holds key zones and then snaps back. This scenario is psychologically brutal because it makes everyone think the move is over right before it reloads. Scenario 2 is the continuation squeeze. In this scenario, the market doesn't give you the dip you want. Gold pushes toward that $4,800, $5,000 conversation quicker than seems reasonable, and silver presses into triple digits because the ratio compresses and shorts get hunted by margin requirements. In this scenario, gap risk is real. Weekend headlines matter more because liquidity is thinner. Your stop loss can become a market order in a vacuum. That's not fear-mongering. That's how thin markets behave. So you don't chase with leverage. You don't all in because you saw a target on the internet. You plan entries. You accept volatility. You respect invalidation. And that's where the real pressure starts. So what are the levels and tells for the next 7 to 14 days? Start with gold. Treat $4,800 as a psychological pressure point because it's close enough to current pricing to matter, and it's a round number magnet for flows. If gold is hovering in the high 4,700s, a clean push through $4,800 that holds, meaning it doesn't immediately reverse and spend the next day below, can act like a door opening toward the $4,hour $900 and then the $5,000 headline level. But the hold is the key. The hold tells you the bid is real. On the downside, watch the recent breakout region and the last obvious impulse base. You don't need a single perfect number. Think zones. If gold loses a major prior breakout zone and then fails to reclaim it within a couple sessions, that's a warning the market may be entering a deeper reset. Not the end of the bull thesis necessarily, but a near-term digestion that can take time and can shake out weak hands. For silver, the tape is more dramatic. Triple digits, $100, is the big psychological line because it's where media goes loud, retail gets emotional, and risk managers tighten collateral. If silver is in the mid-90s, then the high 90s zone into $100 is a battlefield. A tag and reject is normal. A tag, hold, and grind higher is a sign of continuation. On the downside, watch the low 90s and high 80s bands as do or die areas for near-term momentum. If silver dumps through those zones and can't reclaim quickly, you're in scenario 1 or worse, a volatility flush. If it dips and immediately finds a bid that feels angry, quick reversal, heavy buying, no patience, that's the market telling you supply of willing sellers is scarce. And that's where the real pressure starts. Now the tells, the signals that confirm the thesis beyond just watching price like at ESSA Sports Score. 1. How dips are bought. If dips are shallow and fast, that's institutional demand. If dips are deep and slow with weak rebounds, the bid is not urgent and the market is distributing. 2. How the curve behaves. If nearby strength persists and rolling exposure costs more than normal, that's tightening pressure. If the curve relaxes, if the market starts comfortably pricing the future above the present again, that can signal stress is easing, at least temporarily. 3. Volatility behavior. If implied volatility rises while price rises, that's a sign of stress and squeeze potential. If implied volatility collapses while price rises, the rally can still continue, but it may be less explosive and more grindy. Different risk profile. 4. Cross-market signals. Watch the dollar and real yields. If gold is strong, even while the dollar is firm or yields aren't collapsing, that's a stronger structural bid. If gold is only strong when yields dump and the dollar dumps, the rally is more macro-sensitive and can reverse quickly on macro repricing. 5. Institutional narrative, not the talking heads. The actual behavior, reserve policy chatter, reported central bank interest, fund flows into metal vehicles, and broad hedging demand. Even when those data points are imperfect, the direction matters. But that's not the part that matters. The part that matters is what would invalidate the gold to 5K or soon, silver right behind. Storyline in the near term because you need that to avoid becoming emotionally married to a trade. Invalidation doesn't mean a red day. Invalidation means the mechanics stop supporting the story. If gold breaks down through key prior breakout zones and stays below, if the curve relaxes meaningfully, if dips stop getting bought with urgency, and if macro reprices toward persistently higher real yields with a strong dollar while metals can T-hold, those together would argue the market needs a deeper reset before it can try again. On silver, invalidation is even more behavioral. If silver loses key zones and then starts reacting bearishly to bullish news, meaning good headlines can T-lift it, that S distribution. If silver can't reclaim levels after bounces, that's fatigue. That doesn't mean silver is done forever, but it means the easy phase is over and the risk of a brutal mean reversion rises. And that's where the real pressure starts. So how do you navigate this without getting used as liquidity? First, you decide what game you're playing. Are you a trend participant with a weeks to months horizon, or are you a short-term trader trying to scalp volatility? If you're the second, you need tight risk management, and you need to accept you'll be wrong often. If you're the first, you need a plan that survives noise. That means position sizing that lets you hold through a normal silver drawdown without panic. It means not betting your rent on a breakout. It means thinking in scenarios, not certainties. Second, you stop letting headlines be your entry signal. Headlines are late, and they're emotional. Your signals are structure and behavior. Levels, dips, curve, vol. Third, you respect that price can whip around violently even if the thesis is correct. That is not a contradiction. That is how markets transfer metal from impatient hands to patient hands. If you can't handle that, you either size down or you don't play. That's not gatekeeping. That's survival. And that's where the real pressure starts. Now let me put the $5,000 number in its proper place. It's a headline magnet, yes, but it's also a round number that can create reflex behavior. Funds that don't want to miss it will chase as it approaches. Shorts who have been fading the top will feel their risk limits tighten. Media will run the story as if it's a sudden revelation rather than a slow-motion repricing. That can create a self-fulfilling push toward the level, but the market doesn't stop because you reached a round number. It stops when the incentive structure shifts. Sometimes that happens right at the big number because profit-taking meets fresh shorts. Sometimes it happens after, because the market blows through and then mean reverts violently. Sometimes it happens before because the market front-runs the obvious and then punishes the late crowd. You don't get to control which one. You only get to control your risk. And if you're watching silver, remember, silver can make you feel like a genius and then turn you into a cautionary tale in the same week. So stay humble, stay mechanical. But that's not the part that matters. The part that matters is the identity shift you can choose right now. You can be a headline tourist, chasing the last candle and selling the first dip, or you can be part of the small group that watches the plumbing, the curve, the spreads, the behavior around levels, the calendar pressure, and the way participants are forced to react. Those people don't always nail the top or bottom. They don't need to. They survive long enough to catch the big moves. And survival is the alpha nobody screenshots. Over the next 1 to 2 weeks, going into the January 27-28 Fed decision window and sliding into month end, treat every move as a test of urgency. Does the market defend levels quickly? Do dips get bought with conviction? Does silver snap back after sell-offs, or does it bleed? Does gold hold above key breakouts, or does it slip and fail to reclaim? Do you see continuation behavior? Higher lows, fast recoveries, tight consolidation? Or do you see exhaustion, failed bounces, heavy selling into strength? If the market keeps showing you urgency, you stay open to the squeeze case. If it starts showing you fatigue, you respect the pullback case. And in both cases, you refuse to let volatility decide your personality. That's the whole game. And if you're the kind of person who wants the truth underneath the price, the incentives, the mechanics, the what breaks if X happens, you're already in the right crowd. Because you're not here for comfort. You're here for clarity. Keep your eyes on the curve. Keep your eyes on the levels. Keep your eyes on how fast the market forgives dips. And remember, the move everyone mocks at $4,700 is the move everyone claims they saw coming at $5,000.